There is a terrifying moment in every crisis where the cure becomes more dangerous than the disease. We are conditioned to fear inflation. We watch the price of bread go up, the price of gas go up, and we panic. We buy gold, we buy silver, we prepare for the dollar to become worthless. But there is another monster lurking in the shadows, a monster that is colder, faster, and far more ruthless than inflation. That monster is deflation. It is the sudden, violent evaporation of liquidity. It is the moment when the music stops and there are not just fewer chairs, but the chairs themselves have been repossessed by the bank. In a deflationary crash, cash is king, not because it has value, but because it is the only thing that can extinguish debt. And in that moment of panic, when the entire world is scrambling for dollars to pay off their margin calls, the price of everything collapses. Stocks, real estate, Bitcoin, and yes, even silver. Today, we are going to stare into the abyss of a scenario that nobody wants to talk about. A scenario where the price of silver on your screen doesn't just go down. It crashes. It collapses. It potentially even goes negative. I know what you are thinking. You are thinking, this guy is crazy. Silver is money. It has been money for 5,000 years. It can't go negative. But I want you to remember April 2020. I want you to remember the day the price of oil went to negative $37 a barrel. Oil is the lifeblood of the industrial economy. It is essential. And yet, for a brief, shining moment of insanity, traders were paying people to take it off their hands. Why? Because the financial system broke. The paper market detached from the physical reality. If it can happen to oil, the most important commodity on earth, do not think for a second that it cannot happen to silver. We are going to explore the mechanics of a liquidity event. We are going to look at why, in a crash, correlations go to 1. We are going to explain why smart people sell their gold and silver first, not last. And we are going to talk about the wrecking ball that is the US dollar. This is not a prediction of doom. It is a preparation for volatility. Because if you understand how a deflationary crash works, you won't panic when you see the price of silver drop 50% in a week. You will recognize it for what it is, the final brutal shakeout before the hyperinflationary response, the calm before the storm, the retreat of the ocean before the tsunami. Let's start with the concept of the dash for cash. In a normal market, people buy assets to make money. They buy stocks, bonds, real estate, and commodities. But the global financial system is built on debt, margin debt, mortgage debt, corporate debt. When the value of those assets starts to fall, the lenders get nervous. They issue margin calls. They say, you need to put up more cash collateral or we will sell your assets. When a hedge fund gets a margin call, they don't sell what they want to sell. They sell what they can sell. They might want to sell their illiquid junk bonds or their private equity stakes, but they can't. There are no buyers. So what do they sell? They sell their most liquid assets. They sell their Apple stock. They sell their treasury bonds, and they sell their gold and silver. Gold and silver are incredibly liquid. You can sell $1 billion of gold in seconds. In a panic, this liquidity becomes a curse. It makes precious metals the ATM of the financial system. When the big players need cash to cover their losses in other markets, they raid the ATM. They dump their metals. This creates a paradox. The world is ending. The financial system is collapsing, and yet the price of the ultimate safe haven asset is crashing. This happened in 2008. Lehman Brothers failed. The world was on the brink. Gold dropped 30%. Silver dropped 50%. People were confused. Why isn't gold going up? The banks are failing. Because the banks were selling the gold to save themselves. They were desperate for dollars. This is the deflationary phase. It is brutal, it is scary, and it flushes out all the weak hands who thought metals were a magic shield against all volatility. Now let's talk about the paper market specifically. The price of silver you see on your screen is not the price of a physical coin. It is the price of a futures contract, a promise to deliver. These contracts are traded with massive leverage. For every ounce of physical silver in the COMEX warehouses, there are hundreds of paper ounces traded. In a deflationary crash, the speculators who hold these long contracts get wiped out. They are trading on margin. If silver drops 10%, they lose all their equity. The broker automatically liquidates their position. This selling drives the price down further, triggering more liquidations. It is a death spiral. But here is the twist. What if the crash happens near the expiration of the contract? What if the longs are forced to sell but there are no buyers? What if the storage facilities are full? This is what happened to oil in 2020. The storage in Cushing, Oklahoma was full. Nobody could take delivery of the oil, so the contract holders panicked. They had to sell at any price to avoid being forced to take physical delivery of a commodity they couldn't store. They bid the price down to zero and then to negative numbers. They paid people to take the contract. Could this happen to silver? It is less likely because silver is easier to store than oil. You can put a lot of value in a small vault. But in a total systemic freeze, where the logistics network breaks down, where the armored trucks aren't running, where the vaults are locked, the paper price could disconnect completely. We could see a flash crash where silver futures trade at $10, $5, or even momentarily negative, just because the paper mechanism is broken. If you see silver trading at $5 on your screen, what should you do? Should you panic? Should you sell your stack? Absolutely not. You should look out the window. Is your house still standing? Is the sun still shining? Is silver still a precious metal used in electronics and solar panels? Yes, the paper price is a lie. In this scenario, the physical price would diverge massively. You might see spot silver at $5, but if you go to a dealer to buy a coin, they will charge you $50 or $100, or they simply won't sell. They will say, "I'm not giving away my metal for paper prices." The spread between paper and physical would blow out to infinity. The paper market becomes a clown show while the physical market goes dark. This is why you must not use leverage. If you are trading silver futures, a flash crash to negative territory will bankrupt you. You will owe the exchange money. But if you hold physical metal, a flash crash is just a number on a screen. You still have the ounces. You just wait for the sanity to return, and it always returns. Let's talk about the dollar wrecking ball. In a deflationary crash, the US dollar spikes. This is counterintuitive. Everyone expects the dollar to die, and eventually it will. But in the initial phase of the crisis, the dollar is the only thing that matters. There is roughly $13 trillion of dollar-denominated debt held by foreigners, eurodollars. When the global economy slows down, these foreigners have fewer dollars coming in to service that debt. They scramble to buy dollars to pay their loans. This creates a massive short squeeze on the dollar. The DXY index, dollar index, shoots up to 110, 115, 120. Since commodities like silver are priced in dollars, a stronger dollar usually means lower commodity prices. The algorithms see the dollar spiking and they automatically short sell silver. It is a mechanical reaction. This dollar strength is the wrecking ball. It smashes everything in its path. Emerging market currencies collapse, stock markets collapse, and gold and silver get dragged down in the undertow. But you have to understand that this dollar strength is artificial. It is not strength born of economic power. It is strength born of a shortage. It is a liquidity squeeze, and a liquidity squeeze can only be solved one way. The Federal Reserve must print dollars. This brings us to the Fed response. The Federal Reserve fears deflation more than anything else. Inflation is annoying. Deflation is fatal. Deflation increases the real value of debt. If prices fall by 50%, your mortgage effectively doubles in real terms because your wages likely fall too. With $35 trillion in government debt, the U.S. cannot afford deflation. It would bankrupt the government immediately. Tax receipts would collapse, and debt service would consume the entire budget. So, when the deflationary crash hits, the Fed will panic. They will pivot so hard they will snap their necks. They will cut rates to zero. They will restart QE, quantitative easing. They will buy everything: bonds, stocks, ETFs, maybe even corporate debt. They will flood the system with liquidity to stop the deflationary spiral. And that is the moment. That is the bottom. That is when you buy with both hands. Because the moment the Fed pivots, the dollar wrecking ball stops swinging. The flood of new money hits the system and it looks for a home. It looks for assets that cannot be printed. It looks for gold and silver. This is the pattern. Phase 1, the crisis, deflation. Everything crashes. Cash is king. Phase 2, the response, inflation. The Fed prints trillions. Cash becomes trash. Phase 3, the mania, hyperinflation. Real assets explode to new highs. We are currently worrying about Phase 1, but you have to play for Phase 3. You have to survive the crash to enjoy the mania. If you get wiped out in Phase 1 because you were leveraged, or because you panicked and sold, you miss the generational wealth transfer of Phase 3. I want to tell you about the credit spreads. This is a technical indicator, but it is crucial. A credit spread is the difference in yield between a risk-free treasury bond and a risky corporate bond, junk bond. In good times, the spread is narrow. Investors are confident. In bad times, the spread widens. Investors demand a huge premium to lend to risky companies. When credit spreads blow out, when they spike vertically, it means the credit market is freezing. It means banks are scared to lend to each other. This is what happened in 2008 and 2020. If you see credit spreads spiking, get ready for the silver price to crash. It is the warning siren. It tells you that liquidity is evaporating. In that environment, return of capital is more important than return on capital. You just want to get your money back. You don't care about yield. This fear drives people into treasuries and cash and out of everything else. It is a stampede. And in a stampede, you don't want to be standing in the way holding a leveraged silver contract. Now let's discuss the psychology of the crash. Imagine silver is trading at $100 today. You feel great. Suddenly the credit markets freeze. The stock market drops 20% in a day. Silver drops to $80, then $60, then $40. The media is screaming deflation, depression. Cash is the only safe haven. What do? The temptation to sell will be overwhelming. You will think, I'll sell now at $40 and buy back at $20. This is a trap. You might sell at $40, and the next day the Fed announces a $10 trillion stimulus package, and silver gaps up to $100 before you can blink. You will be left behind. You will have sold your insurance policy right before the house caught fire. The key to surviving a deflationary crash is to have dry powder. Keep some cash on the sidelines, not because you love cash, but because you want the optionality. If silver crashes to $30 and you have cash, you can buy. You can lower your cost basis. You can become the predator instead of the prey. But never, ever sell your core stack. Your core stack is for the end game. The end game is not deflation. The end game is the response to deflation, which is hyperinflation. The deflation is just the head fake. It is the recoil before the cannon fires. I want to expand on the negative price theory. How could silver physically go negative? It implies that the cost of storing it is higher than the value of the metal. For oil, this makes sense. It costs money to store a barrel of toxic, flammable liquid. For silver, it makes less sense. You can store $1 million of silver in a small safe. It doesn't rot. It doesn't explode. However, the cost in a financial crisis is not storage. It is capital charge. If a bank holds silver, regulators might force them to hold capital against it. If the capital requirements skyrocket during a crisis, the bank might pay someone to take the silver off their books just to free up their balance sheet. This is a regulatory distortion. It has nothing to do with the utility of silver. Also, consider the paper shorts. If a massive short seller is trapped and the price is rising, they might try to engineer a flash crash to cover. They might dump 1 billion ounces of paper silver in the middle of the night to trigger stops. If the liquidity is thin enough, the price can go anywhere. Computers don't have common sense. If the order book is empty, the price goes to zero. This is why I constantly emphasize the difference between price and value. Price is what you pay, value is what you get. In a deflationary crash, the price of silver crashes, but the value rises. Why does the value rise? Because the crash guarantees the destruction of the currency. The more severe the crash, the bigger the bailout. The bigger the bailout, the more valuable silver becomes. So, a crash is actually bullish. It is the catalyst for the final move. It clears out the debt. It clears out the leverage. It forces the reset. You want the crash to happen. You just don't want to be a victim of it. Let's talk about counterparty risk again. In a deflationary crash, banks fail, brokers fail, exchanges fail. If you hold unallocated silver in a pooled account, you are an unsecured creditor. If the custodian goes bust, you don't own silver. You own a claim on a bankrupt estate. You might get 10 cents on the dollar 5 years from now. If you hold silver ETFs, you are trusting the authorized participants, the sub-custodians, and the legal structure of the trust. In a systemic meltdown, those chains of trust can break. The ETF might not track the price of physical metal. It might trade at a massive discount. Physical possession eliminates this risk. If the price goes to negative $50 on the screen, but you have the coin in your hand, you are fine. You just don't sell it. You wait. You use it to barter. You wait for the new currency to be issued. Physical metal is the only asset that has no liability attached to it. It is pure equity. We are seeing signs of stress in the reverse repo market. This is the plumbing of the financial system. When there is too much cash, it goes into reverse repo. When there is too little, it drains out. Right now, it is draining fast. When it hits zero, the liquidity buffer is gone. That is when the volatility spikes. That is when the crash becomes possible. The yield curve is also flashing warnings. It has been inverted for a record amount of time. An inverted yield curve, short-term rates higher than long-term rates, has predicted every recession in the last 50 years. It is 8 for 8. When it uninverts, when long-term rates go back up, that is usually when the recession starts. We are uninverting now. The clock is ticking. So the deflationary crash is not a conspiracy theory. It is a historical pattern. It is a mathematical probability. It is the immune system of the market trying to purge the virus of debt. But the doctors, central banks won't let the patient heal. They will inject more virus, money printing, to stop the fever. This makes the eventual death of the currency inevitable. What should you watch for? Watch the VIX, Volatility Index. If it spikes above 40, panic is here. Watch the DXY. If it breaks 105, 110, trouble is brewing. Watch the credit spreads. Watch the bank stocks. If bank stocks are crashing, it means they are liquidating assets. That liquidation will hit silver. But remember the timeline. 2008. Silver crashed 50%. then went up 500% in the next 3 years. 2020, silver crashed 35%, then went up 150% in the next 5 months. The crash is the slingshot. The deeper the pullback, the higher the launch. If you are a young stacker, pray for a crash. Pray for $15 silver. It is your chance to build a position that will change your life. If you are an older stacker, protect your position. Don't be leveraged. Have cash to survive the downturn without selling your ounces. The negative price scenario is the ultimate bear trap. It would convince the entire world that silver is worthless. It would make everyone hate the metal. It would make CNBC laugh at us. And that is the exact moment, the moment of maximum pessimism, that the bottom is in. That is when the Rothschilds buy. That is when the Rockefellers buy. Be like them. Buy when there is blood in the streets, even if the blood is your own. This video is not meant to depress you. It is meant to harden you. It is meant to give you diamond hands. You cannot have diamond hands if you don't understand the game. The game is volatility. The game is shaking you out. If you know that a 50% drop is possible, and even likely it won't scare you when it happens, you will smirk. You will say, I knew this was coming, and you will execute your plan. Your plan should be simple. 1. Own physical. 2. Have no debt. 3. Have cash reserves. 4. Buy the crash. 5. Wait for the Fed. That is the formula. It has worked in every financial crisis in history. It will work in this one. The technology changes, the algorithms change, but human nature does not change. Panic is predictable. Greed is predictable. The government response is predictable. We are walking on a tightrope. On one side is deflationary collapse. On the other side is hyperinflationary melt-up. The central banks are trying to walk the line, but they are drunk on power and debt. They will fall. And when they fall, they will land on the side of inflation. They always do, because inflation is a tax on the people, while deflation is a threat to the regime. Regimes always protect themselves. So, prepare for the crash, but position for the inflation. Wear your seatbelt, but keep your foot on the gas. The road ahead is bumpy, but the destination is gold and silver paved. Do not let the paper price fool you. Do not let the screen dictate your reality. The screen is a suggestion. The metal is the truth. In a world of negative interest rates, negative oil prices, and negative yield bonds, a negative silver price is not impossible. It is just the final absurdity of a dying system. It is the glitch in the matrix before the reboot. Be ready for the glitch, and be ready for the reboot. Because the reboot will price silver not in dollars, but in freedom. Stay safe, stay liquid, and stay stacked. The storm is coming, but we have the ark.